Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market today is down 0.6% on the S&P, a whopping 1.6 on the Nasdaq, and up 0.6 on the Dow. Let's take a look at the different sectors. Leading were utilities, energy, industrials, and financials. Lagging were communication services, led by that extremely disappointing earnings report from Meta, which saw the stock collapsing by 24%, a quarter of the stock's value evaporating in a single day. Apple just reported earnings. They reported a mixed quarter. They had beat EPS and revenue, a really tiny beat on EPS, but they missed on iPhone sales. Amazon had a horrendous quarter. The stock is down 20% post-market. We're talking about massive companies. Meta, Amazon, multi-billion-dollar companies trading like meme stocks, down 20%, 25% in a single day off of horrendous earnings results. So let's take a look at the daily chart for the S&P 500. The S&P 500 actually closed today down with a classic candlestick reversal pattern, right? We had a rally, then we had a topping tail rejection, a tombstone candle, and then we sold off. This is a very traditional, typical, classical looking reversal structure on the candlestick pattern. A rally, a rejection, and a sell-off. It looks way worse on the Nasdaq, right? We had a rally, then we had a rejection with a lower high, and then we had that sell-off today, and that sell-off is continuing into the post-market. We're down 1.5 percentage points off of that terrible Amazon report and that mixed report from Apple. Now on the 2-hour chart, the Nasdaq actually had this descending wedge pattern, which can be a bullish pattern if we see a bullish candle follow through with a breakout out of this descending wedge. Now I did go back and check before the market closed at prior times when we had a descending wedge sell-off, and what I've noticed throughout this bear market, it is very rare to see this descending wedge pattern break out to the upside when the PPO is in bearish momentum. Now, interestingly, the Nasdaq has gapped down to a very logical level, this prior level of support. If we take out this level of support at $267, unfortunately, we will have to go all the way down to fill this gap. And at that point, we would be risking taking out the October low. Now, if the market manages to hold this level, we'll have a much stronger chance of this uptrend that we've seen since the October low to continue. The S&P 500 is doing a little bit better than the Nasdaq, well, significantly better than the Nasdaq, primarily due to the strength of industrial stocks, the Dow Jones. Now, the Dow Jones did put in 2 topping tail candlestick patterns, a reversal pattern, a typical reversal pattern. Now, after seeing this and seeing that classical reversal pattern on the S&P 500, I decided to take a short position just before the market closed on the triple Qs. I chose the triple Qs because the Nasdaq was the weakest out of all 3 indices. By the way, guys, if you're interested in following my trades, I do post every single trade and investment that I make in real time in the trading community. It's $30 a month if you go for the annual Ghost Legend membership. Check out the link in the description below if you're interested. Now let's take a look at the smart money. Very interesting development, right? The smart money is putting in higher highs and higher lows, while the S&P is putting in lower highs and lower lows. Now, typically this would be a bullish divergence, indicating that more upside is coming. Unfortunately, something very bizarre is happening with the stock market, a very ominous sign. Let me pull up this chart. This chart is for the Nasdaq divided by the S&P 500, a ratio chart, a relative strength chart. And we're seeing a waterfall style sell-off on this ratio chart. This is very atypical when yields are declining. Now, yields have been falling for 3 straight days, while the Nasdaq has been selling off. This is very atypical. When yields go down, the Nasdaq usually rallies because the Nasdaq is full of big cap tech growth companies, which are treated very much like long-term assets. So they're very sensitive to yields, and so when yields go down, valuations for these companies usually expand and they move to the upside. We're not seeing that. This is the first time this year since the beginning of the bear market that I'm seeing this market behavior. This market behavior is actually very typical of the end stage collapse of the stock market when declining yields are no longer providing uplift to the market. This, unfortunately, guys, goes hand in hand with the imminent doom indicator. This is the imminent doom indicator. The long-term treasuries divided by the NASDAQ. This ratio never goes to the upside unless the market is extremely fearful and selling off and positioning for safety. In fact, let me add the S&P 500 on here so you guys can see what happens when this ratio shoots to the upside. Let's take a look. This was back in the 2020 crash. The ratio shot up to the upside. The market crashed. Same thing in 2018. Ratio shoots up to the upside. The market crashes. And the exact same thing. Happened in 2008. So this is not a good sign. Seeing this crossover, this bearish crossover on the PPO on the monthly chart is not a good sign. The ratio now expanding for 3 straight days indicates extreme fear in the market. Let's take a look at the VIX. This is all happening at a very logical level for the VIX. The VIX is now trading just below the 50-day moving average. I talked about this yesterday. When volatility is in an uptrend, the VIX usually touches the 50-day moving average and then shoots back to the upside, expanding volatility in the market and bringing more selling into the market. Let's add the S&P 500 on here so you guys can see what I'm talking about. Look at this. 50-day touch, sell off, 50-day touch, sell off, 50-day moving average touch, sell off. Same thing here, 50-day moving average touch, and boom, a stock market sell-off. Let's take a look at the dollar. The dollar is now recovering after selling off significantly for 4 consecutive days, allowing the stock market to rally. Now the dollar is recovering, again indicating that the market is extremely nervous. Money is flowing out of equities into long-term treasuries as well as the dollar. Amazon falling off a cliff. It has now taken out all prior lows for the year. Again, does this look like a bull market recovery, the end of the bear market? No, it looks like more and more pain is coming. There's actually no real support for Amazon all the way down to $85 and then again at $68. So be very careful if you're in this name. It will likely move all the way down to $85 and chop around for a while. If we see a continuation of selling, it will likely go all the way down to $68 from a high of, let's see, 190. Let's take a look at Apple. Apple reported mixed results as we discussed. It has now gapped down slightly. The next logical level of support for Apple is around $140 and then again at $138. Let's take a look at the CPC buy and sell signal. The buy signal continues to be active. It has now crossed below 95. Usually when we see that, guys, it indicates an acceleration of buying in the stock market. Let's add the S&P 500 on here so you guys can see. Let's take a look. Right over here, we had an active buy signal. We crossed below 95. We had some selling, then some buying again, crossed below 95. Some selling, some more buying. And right here again, crossed below 95, some more buying pressure. So expect a lot of chop, a lot of volatility, especially as we go into that FOMC meeting on November 2nd, next week on Tuesday. Now, tomorrow, everybody, we do have the PCE inflation report coming out before the market opens, so expect even more volatility. In terms of earnings, we do have Exxon, Chevron, AbbVie, NextEra Energy, and Equinor all reporting before the market open. Most of these, though, are S&P 500 components, but they're not NASDAQ 100 components, so the NASDAQ will likely continue to see weakness and open with a gap down tomorrow. Again, we need to see the NASDAQ hold this level at 268. We need to see this support hold. If it does hold, we'll likely see a continuation of the rally to the upside despite all of the misses in earnings. Now, that's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
I think the narrative is going to start to change on this quarter from the bread and butter old-time business of selling geo-locked advertising to what the metaverse is going to look like. And if you're an investor, you have to start thinking about an issue that is going to involve large advertisers. And here it is. The unregulated metaverse, the Wild West metaverse, which is also getting traction, is not going to be popular with big advertisers, because if you go buy real estate and set up a liquor store or a porn site in the metaverse that's unregulated, that's a problem if you're a brand. What Zuckerberg's going to start talking about is a curated metaverse where he can guarantee you safety in terms of what brands you're associated with. And that's going to have a lot of value. Now, it's not what the Kryptonians want to hear about, because everybody likes the freedom of an open metaverse. But that's, if you're a Procter & Gamble or you're a big brand or a Nike, you simply don't want to set up on the metaverse beside a porn shop, or a smoke shop, or a liquor store. These are the issues that are going to happen. You have to start thinking about the metaverse as a real place for advertising as people start to explore it through the gaming communities. And so I think Zuckerberg's going to start focusing on the value enhanced by being a curated metaverse, and the street's going to pay up for that, because he's one of the only places you can do that. Yeah, you might hate him, maybe he's horrible and get dragged in front of Congress again, but the market doesn't care. He owns it.
Oh, wow.